Hello and welcome to Stock and Roll, the podcast where we deep dive into the world of equity compensation. Today we have a special guest with us, a true legend in both the world of salmon fishing and tax law. I'm thrilled to introduce Sverre Hveding, a friend and one of Norway's tax lawyers. Sverre is not just about reel and rod though, he's been one of the key driving forces behind pushing Norway to enhance our recently upgraded tax beneficial programs for startups. He's got a unique perspective on all tax-related topics to early-stage programs in Norway. Let's roll. Thanks for joining Stock and Roll, Sverre. It's great to have you here.
Thanks for having me, Chris. It's really great pleasure to be here. Seeing your location and staff in full work, everything. Fantastic.
Great. I think that the talks that we've had about this topic before, share incentives generally, and specifically the topic today, have been super intrigued. So I'm extremely excited to have you here and to discuss the topic with you. But first, do you want to give a short intro to who is Sverre?
Hi. I'm, as you know, I'm a Norwegian tax lawyer and corporate lawyer. I've been actually working now since 1994. That's actually 30 years. And a lot of my work has been focusing actually on transactions, tax and structuring, and not at least share-based incentives.
Oh, but that is great. I was 8 years old when you started to work then, so that's, yeah.
Sure.
Okay, great. I'll start off with first, before we start off with the topics, it's always good to, how was your fishing this summer? Was it good?
It was not bad actually, but fishing generally in Norway was terrible for us salmon fishers. They closed a lot of rivers. So we are into hard times now.
Did you catch anything?
I got some fish, yes. A little bit more than 30 fish, but...
30?
Yes. But it was hard times. It's better now in the stock option market, I think.
That's what we others get through during a lifetime. So no, that's cool. Today's topic, that will be talking about the share incentive schemes in Norway, more specifically related to startups. Why is this kind of a relevant topic for you?
It's hyper relevant actually. And in addition to being a tax lawyer, corporate lawyer, I'm also co-head of our venture group in Selmer law firm where I'm based. And we have a lot of venture companies and startups. We have a lot of investors as clients. So you could say that we constantly assist companies establishing and structuring a good share-based incentive program for their employees. And there are many models to pick from. There are different aspects, different pros and cons. So even though you could say that a lot of it's more or less standardized arrangements, it's actually a lot of tailoring too. So we are deeply involved in structuring, preparing documents, etc.
What I think is also, you touched a bit upon it here as well, but I think what's super exciting with the topic now is that it may be very relevant for everything from like founders and early CFOs to owners and also to people that works in startups in Norway, because of that this will kind of give potentially a bit more qualified opinions on what sort of incentive schemes can you expect from your employer. So, yeah.
Absolutely. And what you say is, I think that maybe 15, 20 years ago, it wasn't that common with share-based incentives. Now I think almost every startup and growth company has some kind of share-based incentive schemes for their employees. We rarely see companies that does not have it. So it's super relevant.
Definitely. Okay, so if we start to deep dive a bit into the topic, I have one question first, and that would be like, why is it really different in a startup than what you see in listed companies or more mature companies? It's shares and it's people and it's potentially being a part of a journey that grows. So what do you see as the main differences?
Oh, that's interesting. Yeah. And it's very important actually to be aware of it. No, as I see it actually, in a startup company, you usually have not much of liquidity in sense of cash in the company. So paying out cash bonuses is not relevant. Have to find something else to incentivize your people. There's no market for the shares. We're talking about unlisted shares here. There's no regular market, so it's not easy to sell those shares. You're kind of locked in. Third, there's high risk. Startup is by nature a high-risk investment. So if you are investing a lot of money, that's high risk compared to a listed company. And finally, it's difficult pricing, startup companies, what's the value? That's much more easy in a listed company. So there are many things here that actually in total implies that you have to find a good incentive scheme, or a good incentive scheme maybe should be something with a little bit less risk, and where the pricing today is not so essential because it's difficult to find it, and maybe where the employees doesn't have to invest so much. That could be at least some consideration. So great differences structuring a program for a startup compared to a listed company.
Definitely. I also, one kind of consideration that I've seen a few times as well is that if you're an unlisted company or a startup company and you have some incentive schemes that vests and you have to exercise them or get kind of realizing the values, and then there's no cash and you end up with shares, and then you get like a huge tax bill as well. So if you're in a stock listed company, you could sell off the shares on the stock exchange, right? Yes. And here you may end up with a terrible tax bill. And so I think those things as well is a bit terrible every now and then.
Oh, it's super important what you say, actually. I've seen so many examples actually of having a company granting, let's say, stock options to their employees, regular stock options. Later, we will go back to the so-called tax-favored options.
Yeah.
But if you just have the regular options, the tax bill comes when the options are exercised. But then the employee, then the exercise option and is subscribed for a share in an unlisted company. You can't sell it, but the tax bill comes. I call it the liquidity squeeze, and that can be terrible. So we have seen examples where companies coming to us and say, what should we do? And maybe sometimes you cannot exercise these options because the gain is too high and there's no money to pay the tax. So we have to maybe find a solution where we extend the operating time of the option.
Yeah, no, definitely. I think
so maybe they have to be exercised on exit instead when the company is sold.
Oh, it's easy to kind of make an incentive program into some sort of a shitty disincentive scheme instead. So definitely
can be a trap.
Yeah, definitely. I know, super important. And then if we kind of dive a bit into that again, if you can explain a bit more about like tax, a bit more about like kind of
sure.
The incentive effects in these programs, so that we can kind of go further into the details after that.
Sure. Yeah, fine. I think that starting actually a little bit is that we basically have in Norway, I think generally we have three kinds of programs. We have share purchase programs where the employees are going to buy or subscribe for shares. Then you make an investment, and then you will be a investor position and you will have a capital gain tax. It can be quite favorable, but you need to invest. And then we have on the other side options. You don't have to invest, but the tax bill can be higher because there's tax upon exercise before you have even see any cash.
And also kind of the income tax, right?
Yes, it's income tax from earned income as tax as salary with social security for the employer and everything. So on one side, stock purchase can be quite favorable tax-wise, but you need to invest. On the other side, options is fine. You don't need to invest, but you have this tax trigger. Third type of incentive, cash bonus. Well, it's tax-like options. It's all with salary tax and social security. But then you have at least cash to pay. But for a startup, as mentioned initially, cash bonus is usually not relevant because if you kind of get money from your investors, you are supposed to spend it on developing the product or marketing. You're not supposed to spend it paying tax or bonuses. So then we are stuck with the share purchase programs or the options. That's the two main issues I think we should discuss.
Yeah.
So what about the taxation? You said, I mentioned it a little bit now. If you actually go in and buy a stock for fair market value, that's no taxation up front. You are in the capital income bracket tax-wise, so the future may be good from a tax perspective. And in Norway, you can invest through a holding company. So, for example, for management, investment through one joint holding company or each holding company is often recommended. If the program is broad, covering all employees, maybe it's better to just have them invest directly, because managing all these holding companies can be kind of administrative and costly. But that requires investment. So what actually happened a few years ago is that many of us were working to have better tax rules for options to avoid this option taxation coming at option exercise before you get any money and you will still be a shareholder for several years. Because having regular options for startup and growth companies was kind of terrible due to this liquidity issue. So what did we get? Well, what happened is that Norwegian Venture Capital Association and Abelia, part of NHO in Norway, put down a kind of working group. I was so lucky I was part of that. So we actually worked for 4 or 5 years to have a kind of breakthrough. We got a politicians level, and finally we got a new tax-favored option scheme in Norway. And that's super exciting, actually, because it's a good scheme.
Yeah. Is this like kind of the way this is now? Would you kind of consider this call it like a no-brainer now? So if we can come back a bit to like qualification things or so, but assume that you qualify, is it like worth discussing for companies that there can be other alternatives? Or do you feel that if you kind of qualify, then this is a no-brainer?
I would say it more or less like that.
Yeah.
If there's a company that can qualify, and we will look into the terms after.
Yeah.
But let's say you're a small enough company, you are new enough, and you don't have too many employees, so you can qualify. It's absolutely on the list. Maybe not a no-brainer, but almost. Because if you qualify, it's really favorable.
Yep.
The short form of the taxation is like this. The grant of the options, there's no tax. There's a minimum period of 3 years of vesting. There's no tax when the options are vested. And the employees may exercise the options without no tax. So there's no taxation at any time here. The tax comes at the end when the shares are sold. So let's say you grant options to 25. They are vested to 28. And the employees exercise in 28 and 29. But the tax is not due until the shares are sold. Let's say 232, there's a successful exit. Everyone is happy. And then you get the tax bill.
Yeah.
And then you have cash to pay the tax. So it's actually no problem. And that's not even enough. The tax is not taxed as salary. If you have a tax-favored option and you come to 232 and you sell it, it's capital gain tax, or actually more precisely, it's share-based taxation. That's 38% tax instead of up to 47%. So it's not only a favorable time of taxation, but it's a favorable tax rate. So you can say getting into this scheme is usually considered very favorable.
I agree. And I think like as long as you don't have like a super strong desire as a founder or as a company that one of the most important design elements is that you really want people to invest money at time zero, then I agree. I think it's like definitely a no-brainer.
Yeah. And as you say, this is an option program, so there is no skin in the game.
Nope.
So if the company says that, no, our incentive plan need to have some skin in the game, meaning that the employees should invest something, well, then this program isn't the right one. And that may be the case maybe for some of the management, for example, but maybe not for the regular employees.
Yeah.
So here you can have combinations of programs.
Yeah. And also, like on that note, I've seen a few that has also said that you need to invest a bit, but if you invest, you qualify to the options. So you can say you invest 100, and then you get options of a 1-to-3 ratio, an example. So per 1 you invest and buy, you get this tax favorable part 3. I think that is like kind of, you can actually use it as one piece of a bigger
that
thing.
That sounds like a smart combination, Chris, because then you have the best of the two worlds.
Yeah. Definitely.
And maybe many startup companies too, they need some money. So if they have management that could invest a little bit, that actually helps a lot.
And I think often the problem is that, yes, they can invest, but they can invest call it like a smaller amount because of the salary is already quite low and you've already trying to establish in a big city or so. And then it's like, okay, but can you invest something? And relatively for you, it can be quite a lot, right?
Yes.
And then you still want them up to X exposure, which is like significantly enough for kind of feeling a bit as an early employee / co-founder / whatever you call it.
Yeah.
I think it's a nice way of gearing it up a bit at least.
Yeah. It's a very good point. That's absolutely.
Are there any kind of, because now we've covered a bit like this tax favorable, and we will definitely come back to that one. But before we do that, do you see that there's any other kind of alternatives out there than just kind of buying shares in a clean form and this kind of tax favorable setup? Do you see any other elements, just to cover up that first?
Yes, absolutely. Before we dive into the details of the tax favored options, yes. Well, I mentioned that stock purchase programs. And what we often do with startups, first of all, those who doesn't qualify for the tax-favored options, they need to find something else. And those who want skin in the game. So what we actually many times do then, we make some tailored solutions where the employee is given the chance to invest in a share. Let's say the share value is 10 per share, but we say to the employee that you can buy this for 2. And the 8 is payable only in the future. So this is a sort of a loan or a financed share purchase. And according to Norwegian tax practice, this developed actually around the year 2000. It was called the Kruse-Smith model. You could actually have a share with a value of 10. You maybe pay 10 or 20 up front, but on exit, you pay the additional 80 or 90 as a sort of a credit amount. This was accepted by the Supreme Court. And of course, this is a favorable model because then the employees may come into the company as an investor, but only paying a fraction up front. So the Kruse-Smith model, or a sort of similar model where you have a little bit different structure using a real loan. Both those models, depending on the company's balance, accounts, etc., are used.
Yeah.
And they're quite regular too.
Because just one question there that I every now and then have got on those items. It's like, it's for Norwegian startups, they kind of know a bit that you can't kind of offer a loan or anything if you are not in a position to pay out dividends, something like that.
Oh, that's true.
With Kruse-Smith, as you call it, or kind of any slight different variations of of Kruse-Smith, can they be used, or is it like, since you're not in a dividend position, you cannot use Kruse-Smith?
No, you can use it actually. You just have to structure it as a kind of pure Kruse-Smith model.
Yeah.
And at least most of us, we mean then that you are then outside of the regulation as a regular loan.
Yeah.
You then you just structure this not as a loan, but actually as this amount that you don't pay up front is not called a credit amount, but you call it actually an additional purchase price payable on exit. So you structure it more like an earnout than a loan.
Okay.
Then it should be fine. And it's done massively.
Cool.
Sometimes we also actually, just to safeguard the model and the tax consequences, we ask the tax authorities for a binding ruling. Bindende forhåndsuttalelse in Norwegian, but the binding ruling is often used too.
Yeah. And a follow-up on that as well, related to the risk of it, because sometimes I've heard that that there's some concerns about, like, is this really an investment, or do you actually take risk because of that? You can go as low as like 7% you do, as it did in the Kruse-Smith model or in the Kruse-Smith ruling. Are there any risk that if anyone do Kruse-Smith and they earn, like, they are part of the next Spotify, it becomes like a super unicorn, and then they earn a lot of money on it, can the tax authorities then, can it be some sort of like a new court where it kind of looks at it differently if it's that case? I understand that you can't give the exact answer there, but just interesting to hear your thoughts on a high level of it.
Yes, it's a very good question. And no, in my opinion, actually, there should be no chance of that. This model is so established, more than 20 years, and a lot of binding rulings has established that as long as the employee does some kind of investment, at least 7%, we always recommend at least 10, just to have a little bit margin. Then the risk is enough and the risk is good enough to be in a capital tax position. So the future gain would, in my opinion, be absolutely a capital gain subject to shared taxation. What is a little bit downside is that the tax authorities, they have the recent few years, they don't like this model because they find it too favorable. So they have issued a couple of rulings saying that if the company doesn't go so well, so that the employee never comes to the position where this additional amount is split between what's paid up front and the value at acquisition, if that is never paid. So let's say, again, the share was valued at 10, the employee buy it for 1 crown each with a 9 payable upon exit. But then upon exit, the share value is only 1. So actually the share has fallen in price from 10 to 1. It's been a disaster. In that case, there is never any additional payable by the employee. Then the tax authority says that in such cases, those 9 that is never paid shall be treated as a sort of debt forgiveness, which is subject to salary taxation. So in this case, the employee would have an additional salary of 9 per share, which could be a lot of money, and they need to pay the tax bill. That's very harsh, because then the employee maybe has lost his job, he has lost his investment, and they have a tax bill of this deemed debt forgiveness.
Yeah.
That's the downside of this Kruse-Smith model.
But you feel that that is actual risk? Because that is quite devastating if you kind of have to bear that potential.
It is a risk, actually. I have 2 cases now where that has happened.
Okay.
Companies that has not gone very well. The values are almost diminished. And we are now trying to see what can we do to get away from that tax bill. But it's not easy, actually, because, the situation is as it is, and the ruling from the tax authorities is quite clear on this. So this risk of a, let's say, leveraged or gearing purchase of shares is really a risk to be considered.
And I kind of find that when you say it, it makes a lot of sense also, right? And not that I kind of want it to be harder for the founders or kind of the early stage employees, but I think if you look at it as something, if you kind of really say that you take the risk for the entire investment that you do to end up in a capital gains tax bracket, then obviously if you can lose everything and then so I think it makes sense.
Oh, it's true. So Chris, that was the 2 main programs. Options, and I guess we should discuss a little bit more about those tax favored options, the terms, ups and downs. There are some hiccups there as well. And we have this Kruse-Smith, or actually leveraged share purchases with some risk. But maybe that's a subject for a different session,
I think it's a subject for a different session. And I think what I learned from this, which I find really, really interesting, is that this actual risk of if the company kind of goes belly up, and then you have to kind of pay salary tax on, call it the delayed payment or a loan, or call it what you want. That is quite that's new to me, and I think something that everyone listening would kind of find a bit of an eye opener, and so that's thanks for that.
It's really scary, actually.
Super helpful. Okay, no, but great, Sverre. I think it's as mentioned when we started, it's you have a lot of insights in these things, and I could have carried on for hours just about what we've talked about now as well. And I think Kruse-Smith is definitely a candidate for a later episode.
Absolutely.
So just to give a bit of insight to the listeners about the current tax favorable option scheme in Norway, because it's been quite a lot of work being done on this, and there's been different iterations to kind of try to summarize the old iterations. It's always been a bit I think personally, I believe that we've been really good at classifying the gains as capital gains, meaning that lower tax fees than income. And we've also been really good at making the tax, call it, fall at a right time, basically when the shares are being sold. I think this is a bit on the contrary to what we see in many other jurisdictions. However, the way I see it, the biggest challenge that we've had is that the needle eye of qualifications have always been to too tight. So basically meaning that it only comes to like super small companies or small companies in the absolute startup stage. And when you really need to scale, you've basically been falling outside of this. Quite recently, like this, actually last week, I think it was on the 12th of March, there was new rules that came into play. And these things are really good for us, I'd say, because this needle-eye has kind of, if you focus first on the company side of it, we have now gone from companies with 50 and then it was 80 employees. Now it's suddenly 150 employees. And that is a really good increase, I think. It's a bit more than what I would have suspected as well, or expected. On the balance sheet, we used to have 80 millions. Now it's suddenly up to 200 millions, which also is a huge difference. And then obviously in 200 millions, that's quite a lot for a startup company. And we've extended the time from 10 years from start until 12 years from start. And also know that these things are being measured at last year. So let's say you qualified on these things in 2024, then you can still do grants under this in 2025, even though you expect to kind of cross any of these limits in 2025. The challenge with the new suggestion, the way I see it, is a bit that they did not change the revenue limit. It's still at 80 million NOK, which I find a bit strange, because changing the other ones into, like, let's say 12 years, it means that companies that grow fast and that actually have success and then really wants to scale and then are even more in need of more people, then you're suddenly outside. So if you compare the old one versus this one, it's kind of releasing a bit on the qualification criteria on time and kind of size, but revenue, or call it like the biggest success factor, is not increased. So I think that is a bit negative, but isolated, of course. Like we're moving in the right direction, and it's easier to qualify, and it kind of helps companies for a longer time period. I think those things are stuff that we would be very happy with, and if everyone kind of understands these elements and are able to use it for a longer time, it's definitely a positive thing in Norway. When it comes to the awards, there's no change versus the last part. I think it's still a bit like what we call earliest exercise date. It can't be before 3 years from grant. Which I think makes sense. Typically, a startup or a growth company needs time. So having people earning their options and exercise it and earning a lot of money within the first year is not really aligned with what we need as a company or even as a country, I'd say. So it makes sense. Strike price, basically meaning what you have to pay for the share in the future in 3 years' time or more, needs to be at least the market price of the share at time of granting, meaning that if you raised money at a share price of 10, then you can't issue options with exercise price or a strike price at 8. It needs to be at least 10 to qualify. You can still do it, but then you won't fall under this kind of tax beneficial scheme. I think those two things are the most important when it comes to the awards, meaning like earliest exercise date, 3 years, and then you have the strike price. When it comes to employees, there's also some requirements here, not changed, still the same as that has been for a while now, and that is, you need to be an employee, and that is defined as you have to work at least 25 hours per week. So it can't be like a small part-time job. And I think the other major to kind of keep in mind is that if you own more than 5% of the company before the grant or the option allocation, you will also fall outside. This is to kind of be able to, this is to motivate new people, people contributing, but not necessarily a top-up for founders and other investors kind of that stay there. I think that also sums up the most important elements related to the awards itself and the employees. Again, no change, but keep that in mind when you design it as well.
We've touched a bit on some of the weaknesses here, but do you think that there's any other
threats, risks, weaknesses in the program that people that look to potentially launch a program should be aware of?
Yeah, no, that's a good question. We have touched upon, as you say, that strike price need to be existing and at least today's value. You can only have options in the employer, not in a holdco.
Yeah.
There is one more, and I also mentioned this issue of don't grant the options prior to the employee starting.
Yeah.
But there's one more thing, actually.
Yeah, should.
Let's call it issue number 4. The employee cannot hold these options through a separate holding company. Because in Norway, as you know, there's very common to have an investment company on your own. Due to our participation exemption model, making capital gains from shares tax-free in your own company, many people would like to have the flexibility that if these options could be held by a company owned by the employee, could have the same system, and when the shares are sold, the capital gain would be even tax-free in this holding company. And the employee would pay tax when he distributes dividends to himself. Well, it was discussed by the parliament. It was deemed to be too good.
Yeah.
So actually, if you are going to qualify for the tax-favored options, that need to be personal ownership.
Yeah.
Meaning that, let's say if you have your company, then you may be too large now, but
depends.
If you have this program implemented, and then you have a set of employees now after some time that have these options, and they all exercise, and there's no tax on exercise, so it's all fine, you know. But then you would have a group of investors investing in up to through companies and corporations. They are in the tax-free treatment under the Norwegian tax exemption model. Whereas your employees, which maybe be 20, 30, 40 people, they are investing privately.
Yeah.
This gives a lack of flexibility if it is relevant later to do transactions that is not cash transactions. For example, contributing the shares in the company to another company in exchange for shares. So if you do a stock-for-stock transaction, then your employees will have a problem because they will then be taxed, but they have no cash.
Yeah. But I think to me, this is a bit like also employees. Do they get this as a part of their compensation?
Yes.
If it's a part of their compensation and they need to render services, it's closer to salary than for an investor, right? Yeah. But if you can say that, no, but I give away my salary and I invest it. Yeah. So it's like a definition thing. It's a bit hard to kind of...
Yeah, I see that. No, I just wanted to mention this because we had quite many questions. Oh, can you have the options in a holding company?
100%.
The answer is no, you can't.
No.
This is a private thing. It's you as an individual that hold the option. Yeah. And you as an individual will be the shareholder.
Yeah. No, definitely.
So, and this may not be detrimental, but it's good to know.
Yeah. Next item is what do you need to get it up and running? And what I mean with that question is that like we have a question saying, okay, we want this favorable stock option program that is now in Norway. Let's say you've been through everything that we now discussed. So basically you qualify and you know that this is a no-brainer. This is where you want to go. And then what do you do then? Because obviously like founders and early people here are not experts necessarily in the domain.
Sure. Well, I have some ideas, and I think actually, Chris, you are probably, you know this as good as I do. But let's take my ideas first. And I think, first of all, the top management and the board of the company, whoever is setting this up, need to think about something. You need to do some considerations. The scope of the program, how big should it be? What's the frame of it? An amount of number of options and or percentage of the total shares. It's very important to find out if you want to have 2% or 10% program. Secondly, who should participate? Is this a program for management only or for all employees, for example? Third is the strike price and the valuation, because when you implement this, you need to have a valuation of the company to find the value of each share, which in turn is the minimum strike price. So you do have to do these considerations, I think. That's a good start, at least. Maybe you are thinking of other issues too, Chris.
No, I think that makes a lot of sense. I think first kind of you need to know what are you actually doing and kind of have the kind of the frame of
everything. Well, when you have passed that, in our advising, then we would usually advise the client and explain to them what you need in form of documentation and process, because you typically need a share option plan or stock option plan document. I'm in favor of using a plan document and in addition a sort of grant letter instead of having option agreement with each and every one employee. If you have an option agreement, then you have an agreement with each and one. But if you have a plan document, you make one set of document that applies for this option program at any time, and you have a grant letter that is individual.
And basically this makes you have like one catalog with all the general kind of terms and things, and then you have like one small one-pager which kind of includes the specific details to you as a grantee and to kind of the numbers of options and dates and so on. I agree.
And the reason I like the plan document version is that if there is a need to make adjustments to this after 6 or 12 or 18 months, then it would state in the plan document that the board of directors have the discretion to make adjustments. Then you can just make them. If you have an agreement with each and every employee, then you actually cannot just change an agreement on one side. You need to have the employee to consent. It's a much more bureaucratic system. So even with relatively few employees, I think a plan document, grant letter is fine. And so this needs to be prepared. And in these documents, of course, there are many terms and conditions that are not only standard, but need to be discussed with the client to have a good program fitted for this particular company. And with respect to process, I think it's important to remember that implementing these kind of programs, first of all, it's the board that should own it and adopt it, but the board should also go to the general meeting with it. Because in every program where there's an option and someone has the right to subscribe for a share, it must be approved by the general meeting. Otherwise, it may not be legally binding. This is a very important issue, particularly from the employee side. We have seen cases where the employees has been promised options from the board, and later the general meeting, they will not issue the shares, and then the employees are stuck. Maybe they can claim some compensation, maybe not. But my advice is always, if you're going to do this properly, have an approval with the general meeting, and often also have a power of attorney from the general meeting to issue the shares.
One comment on that as well, based on some experience, is that like these minutes from the general meetings, that you kind of try to make them, of course it needs to kind of satisfy all formal needs, but besides that, try to make it quite round and with some space, because what we've seen sometimes, if you in the kind of minutes from the General Assembly, you say it should be awarded with the strike 2 and with a grant date X, then you kind of, obviously that's an extreme example, then you can't really use it to anything else, but also like saying that the option should be 3 years vesting, or this is the structure, and then suddenly you have one key employees that you need to negotiate with, and you have to do something else, right? And then you're bound from the General Assembly, and it's easier then to kind of negotiate with the board. So we'll have it a bit broad with say, and of course there's examples here, but don't go into too much detail.
I agree completely with you there. Don't put too much strain on it. Have the board to have the discretion, so that the general meeting, they can approve the frame,
how many
scope, how many instruments, etc. But then leave the rest to the board. I perfectly agree. So that's kind of document, process, considerations to have it up and running. And of course, then when you more or less have it ready, they should go to you, of course, to have an implementation of it in your platform.
I think like I think it's very important that at least you make sure that you have a good way of keeping control over stuff. I think it's important to make sure that you don't do any mistakes in it, because it's people's salaries and compensation, and also that people understands what they get. I think like if you feel that you do that in a perfect sense with Excel and PDFs and of course then you're still kind of getting what you want out of it, but but like finding some sort of an administration tool, if you kind of feel that you pass a number of people, and of course we have opinions on where that is, but I think make sure that it's under control and easy to communicate. So.
Yes, and it's not only about having control actually and communication, it's also about reporting, yeah? Because I know that your platform, you can take care of the reporting too, and accounting issues and the tax issues when you come to that. So
yeah, no, definitely.
And that's how to get it up and running, as you say.
No, definitely, and thanks for that. Definitely. There's we shouldn't go too much into the details, but in this kind of terms and conditions, I think there's a few items that typically should be discussed and that the listeners should be aware of. Do you have any examples on things that should be there and best practice on those things?
Yeah, sure. I think, as mentioned, actually, with discussing the format, should you have a plan document with grant letter or a separate agreement? I'm in favor of the plan document because it gives you the possibility for flexibility. And then you need to remember to put in a clause saying that actually the board can adjust within the reasonableness, maybe not material conditions, but adjust and make adjustments.
Yeah.
One provision I think personally is very important is to not only describe that you have a share program where the employees may exercise and subscribe for shares, but you have a clause saying that in the company's discretion, the board may decide that instead of issuing the shares, the company may pay out cash to the employees, as allowing for a so-called cash exercise. This gives the company a flexibility. At the day when exercise is closing, you can cash it out instead.
Yeah.
This is a clause for all option programs, but I think should include it also for the tax favored.
Yeah.
Not necessarily because you want to use it, but then you have the flexibility.
Yeah.
There could be circumstances 3-4 years after grant saying that we let them exercise, of course, the employees have the rights, but we will cash them out.
Yeah.
Because we don't want them actually as shareholders now.
Yeah.
So that's a clause, make it possible at least to cash out.
Can I add one thing there? Because the way I see it, it's also a bit like, let's say that you come in a position 4 years from now where new general assemblies don't really continue to approve, that you should kind of be able to emit new shares.
Yeah.
Hence you get in a squeeze because you have already approved options, but you can't really get the shares.
Yeah.
So I think like also having kind of that one twisted to say that in events where the company cannot retrieve shares, that employees should be get cash compensation. Because bonus you can give, or cash bonuses you can give to compensate, but you can't really force future general assemblies to emit new shares, if I understand it correctly.
That's absolutely correct.
Yeah.
You can't force it unless they have given a power of attorney to the board to actually issue the shares.
Yeah.
But those powers, they last only maximum for 2 years.
Yes, that's right.
So if you implement a option program now with at least 3 years before exercise, because you need that,
which is the
minimum
topic.
Then you need a new power of attorney after 2 years.
Yeah.
So you're absolutely correct. But that's one of the reasons I think saying in the program that if the company wants to, they can choose a cash exercise, but also a second regulation, which is in favor of the employees, saying that if the company does not issue the shares, will not or cannot or whatever reason, then the employees may be entitled to a cash benefit. I think that's just fair.
You can also, I don't, you shouldn't assume that people are, call it evil, but you can also think in a case where, let's say that there's millions of gains in the program, but they're not really kind of vested and or not really kind of at a time where they've been able to exercise it. And then could be that the shareholders in turn against this kind of program and the early employees that have these incentive schemes, and they can say, we won't approve any further emission of new shares, right? So I think it's important in those cases to be in the paranoid example, but have the employees to have that sort of right.
Yes, I absolutely agree. And maybe some people would say to me, well, but Sverre, now you are advising the employees and not the company. You are the company's lawyer. But then I would say to them, yes, I am. But, in order for you guys to have a good program, it must work as an incentive program. And employees are able to read. And some employees have also heard about these issues. So if you doesn't implement balanced clauses, it may not be that you end up with a good incentive scheme.
Yeah.
And also, if you do promise employees options and the right to have a future gain here, I really can't see no reason that you should not implement clauses that actually will give them this.
Yeah, and I've actually been in a case where this has been the topic, and I think even though the client was or the company was a client of ours, it's like for me personally as well, in terms of like making sure that options remains a good tool and that we can kind of use it. I think it's very, very important that that the employees should kind of get what they were promised in a way here.
Yeah. So this cash exercise opportunity, but also cash exercise obligation.
Yeah.
I think it's important. Other important clauses, of course, is like the vesting clauses.
Yeah.
For a tax-favored option scheme, you need at least 3 years vesting period so that the options cannot be exercised before 3 years.
Question.
Yes.
Do it really need 3 years investing? Because now I'm kind of not trying to put you in the trap here.
I see.
So earliest exercise. So can you say it vests in 1 year, 2 years, 3 years, but they're not allowed to exercise before 3 years?
That's correct. You can do that.
Yeah.
Absolutely. I was too quick there. So you can have an earlier vesting so that the options are sort of earned and satisfied. But I think it's from a pedagogic point of view, it may be better to say that no, in these tax-favored schemes, we have 3 years vesting and there's a cliff. So there's no option that is vested before 3 years.
Yeah.
But when 3 years has gone, then it's fine.
Yeah.
Because you won't risk that you have employees exercising options after, let's say, 2 years.
100% agree.
Because then the employee will trigger herself into a salary tax position upon exercise, and the company will have to pay Social Security. So, but you can actually structure it if you want to with gradual vesting and maybe an exercise forbidden.
Yeah. Definitely. And what we've seen there is that it can be cases where it's a bit hard for people to join and saying that I need to kind of be there for 3 years before it's any value. So I kind of want the opportunity to leave after 2 years. I understand that I lose my last tranche of it, but I understand that I can't exercise or earn anything. But yeah.
But then we have an issue. That doesn't work actually.
No.
Because if you have in a tax-favored option scheme, let's say only 2 years vesting, and you let your favored employee leave the company after 2 years and 2 months, so you say that, oh, your options are vested. We will not take them away from you, but you have to wait to exercise. Then these options will be exercised at a point of time where the employee is no longer an employee. And that's a breach of the rules too. So I didn't say that initially, that one of the terms is that
you have to be employed.
Yes, you have to be employed at grant. Be careful not to grant the options too early. And you have to be an employee at exercise. So you can't leave.
No, good. Or you can leave, but you won't get the tax favorable.
You can leave, but then the options need to kind of just disappear. Then you lose it.
No, but great. I think this makes a lot of sense. I just wanted to add one more thing that typically like companies ask. You make a 3-year vesting schedule that we just talked about. But what if the company are being fully acquired 2 years after? So this is like on the terms still, like what you put in your terms and conditions.
Well, there's an exit.
Before vesting. Do you lose your options? Do you keep your options? Do you keep part of it?
Oh, that's a good question, and it's actually important to consider this. Well, basically, you could say the fact that the stock of the company changes owner and get a new owner in an acquisition does not forfeit or disrupt the options. The options are still valid. However, in M&A processes, it will be very usual and common that the buyer say to the seller that, well, we see that you have this stock option program. Maybe they say, we want to continue that as is, but there's no problem. Or they say, but we have our own programs. We want to implement our own incentive programs for the employees of the company we buy. So this is it's much of an issue actually depending on what the buyer policy is.
Yeah.
But the basic starting point is that even if the share changes owner, the options are still valid and existing and they are not affected. So the buyer may choose to just continue it.
Yeah.
And after another year, they are vested and then the employees can come on board.
Yeah. And if you have this kind of clause saying that upon a change of control defined as more than 90% or 50.1% or so, all exercises should be accelerated vested.
Yes.
And kind of a part of like the settlement fee, you'll be treating as a shareholder basically. Would that have any consequences on the tax treatment of it? Because you haven't kind of kept this 3 year until exercise, but on the other side, is it fair that you may be the CEO in this company and you've been running this process? Should you be kind of harmed because of this transaction?
That's a good point. Good point. No, I definitely see it. No, it's actually, yes is the answer. It does affect the tax treatment because accelerated vesting is good, of course, because then all options are in the money. And as an employee, you get your fair share of the cake, which is fantastic. Even before vesting. But then you haven't held the options for at least 3 years. In this example, you will be subject to salary taxation. So, but the good thing in this case is that in this case, there is an exit. There's a cash payment we have to assume. So there will be cash to pay the tax. And also, let's remember that share taxation in Norway is now 38%. The maximum salary taxation is 47.6. It's not that big. So I think most employees, they would be happy and should be happy saying that, oh, there's an exit a little bit prior to what we expected. But we haven't accelerated vesting. We are in the deal. We get cash. We can pay the tax. I think that's workable.
Yeah, I agree. And I won't spend time making that into a problem, but I think it can be some problems when it comes to what if the price is kind of lower? What if you kind of lose it? What if you're fired after kind of this M&A and that kind of made you lose it, right? And there's a lot of these things. But again, let's not do it.
I agree with that.
But it's okay to be a bit aware of it for the listeners as well.
But your question, Chris, actually highlights something. When you make the plan document for the stock option program, you need to think what could happen upon an exit. What happens if the company is acquired prior to the vesting, etc., etc. So a good plan document take all this into consequence.
100%. Oh, great. I think then we've touched well upon also like the terms and conditions and things we need to kind of get up and running, and also like a few of the items to discuss in that one. Of course, there's tons of more things here, but I think that would make it a way too long podcast, and we can do some more later as well. But some questions that we get very often is like, and also part of the, call it public debate. How are this item specifically in Norway versus other countries? And knowing that you're not like a tax lawyer for other countries, but do you have any thoughts on how we are? High level, Norway, Germany, Sweden?
Yeah, absolutely. Historically, Norway been terrible. Norway has had no real good option scheme. We have had this political consensus, more or less, that options are not so good. And we should almost hinder it.
It's dangerous.
Yeah, and it's not good in a social democratic country where you have a Labour government. Having said that, we know that the last few years we kind of got a breakthrough that also, or almost all parties now recognize that we should have and we need some special incentives for at least startup and growth companies. So therefore, I think now the arrangement we have, and particularly after it's been extended to cover more companies, it's quite good. Sweden had their arrangements, And they have a few other arrangements too that are actually very interesting.
Yeah.
One of them is that you can value the options and pay the option value as a premium, and then you have capital tax for the rest period. Germany has some rules. The UK has, I think it's EMI rules. So almost all Western European countries have some kind of scheme. They are all a little bit different. So let's say now that maybe Norway is now closing up to the others.
Yeah. No, I agree. And I think one thing that we tend to forget a bit in Norway, if you look at the others, because it's very easy to kind of look at, of course, Germany with their Future Financing Act, they kind of can, it is a lot more companies that qualify. But I think one specific thing that we should appreciate in Norway is that right now it's actually possible for those that qualify to get capital gains tax on everything. It's not just kind of you get taxed when you sell, but you also get capital gains tax.
Yes.
Many of the other countries, to generalize a bit, they look at what would the income tax been, and they just delay it until sales and then add the capital gains tax elements on top of it. And that is actually quite positive here.
Absolutely agree. Absolutely agree.
Great. Some of the questions we get is also related to how broad should we go? Who should we include? Is it like employee number one and then no more? Do we include all employees in the company? Do we differentiate between people? Just like some high level thoughts on your experience here.
No, again, it's a good question. No, I think we see both actually. We see many programs that are focusing on management only. I call it the smaller programs for management incentives. And we see many programs going broader, qualifying more or less all employees. Both is common, and I think there is no rule here. This is one of the important issues, actually, the board need to consider. For a startup and a growth company, of course, many of those companies have employees on board that hasn't worked too long. They may not know them too well. But again, we are talking about options now and not a share purchase program. So this is a really concrete issue. I'm not sure if I can give a sort of general opinion here. No. What is your experience here for growth companies unlisted?
Yeah, I think what we see and sometimes recommend is that when the company is very young, like kind of pre-10, 20 employees, it's common to have some sort of a solution that includes everyone, because then you can say everyone should be closer to founders in a way. They should kind of be second step founders, really need to kind of pull the weight, and also common to kind of be a bit below kind of average salaries in your position and so. So I think broader, and then as you grow a bit, it's more common to start differentiate. So when you pass like 20, 40, 60 people, kind of just go a bit slimmer in terms of like top management, key employees, and so. I think it's always, as you say, a case by case. But if kind of forced to answer a bit like these are the things, I would say so. And when you further grow over that as well, I would then start potentially initiating some investment schemes that includes more people. That doesn't really that have some different mechanisms. So.
And of course, there's always the opportunity to make a different number of options to different groups of employees.
100%.
So even if you include all, could be one scope then for the, let's say, group number one, group number two, group number three, and then the top management. So you differentiate in practice, but at the same time, all is included. And that is also very, very common.
I actually think that is something this again, just personal opinion, but I think that's also something you should do. Because of that, it's very hard if you have 20 people that gets exactly the same.
Makes no sense.
The kind of top performers and the most important persons will as being a human being, kind of struggle a bit with that potentially. So.
Oh, that's the answer. And at the same time, if you have only 20 people and you give options to 14, what about those last 6?
100%.
Maybe they feel that they are worthless. So just at least then create a second group.
Definitely. And I think also careful here with kind of your culture, because there's some companies that have a different culture where everyone is fully equal and then of course you shouldn't start differentiating on options without thinking through that. So that's always a moderator. Awesome. We're getting closer to the end here. I have one final question, and of course you're happy to add more as well. But
Sure.
I think frequency when you plan, should you kind of say that we do one program now and that's it? Should you do it like on annual basis? Should you do it ad hoc when you need? Any thoughts around that part?
Sure, absolutely. Well, if we have the regular option programs or stock purchase programs, etc., I think that planning the future, and let's say have a frame of X% of the shares of the company, but granted over several years, usually make good sense because you then create a long-term incentive plan. There's a new options every year. Every year. And the vesting is also every year then. So you create something long-term. With the tax-favored options, there is one hiccup doing this. And that is that the company may grow out of the terms and conditions. Because remember, this is only for relatively small companies. So I think that it's important that the company look at its own goals, consider where are we in this year, and where are we next year and the year after. And many companies qualifying will realize that, this year we qualify, already next year we are out. So then the answer gives itself, But if possible, I think having it repeated 2-3 years is good. But I think we could say, unfortunately, due to those limitations we do have with respect to turnover and capital base and number of employees, etc., there is a limitation here in tax-favored schemes compared to regular schemes, purchase programs that could last much longer.
I fully agree. I think it's important to kind of to have a toolbox here that are able to kind of retain the ones you have now continuously and also have something for future hires. And that I kind of doing it a bit on an annual basis, but then if there's any specific things.
Absolutely.
Great. So last question, which is not really a question, but I think first of all, thanks so much for all your valuable insights. It's like talking to a library of options and tax. So it's always
my pleasure.
No, it's this time is mine. But as a last kind of favor, would you mind trying to kind of sum things up a bit? If we say that's a Norwegian company with 10 employees that wants to incentivize their people, what do you do in a swift way?
I think it's quite easy, actually. They just call me. I think actually, yes, joke aside. Get some qualified assistants. I think is actually a good idea. From you guys setting up this program all the time, or from a qualified tax advisor. Because then we could together look into, does the company qualify for the favored stock options? If they do, and the employees do, and the options will qualify, we need to check everything, then that is definitely a solution to discuss. And then we could discuss some pros and cons with having that. If they do not qualify, they have to do something else. And then I think it's fair to say that some kind of share purchase program is the choice. And often if the company is young enough, maybe have no external valuations, etc., it's a good opportunity to get the employees on board at a low value, which makes it very attractive. If they even have a pricing, maybe we need to look into models where there is a sort of gearing. That maybe is a summary, Chris.
No, that is great.
But the important thing is to know that there are possibilities to create good programs, but you don't do it yourself, actually.
No.
Seek advice, because there are so many loopholes. And I've seen some cases where people think they know how it works, and it's just a big mess.
Yeah, no, I totally agree. I think that makes a lot of sense. And I think based on what we've covered as well, it's this should be a good toolbox for companies that are looking to issue any type of incentive programs in Norway and are looking to do that kind of as a startup or a growth company. So I think this is great. Good, Sverre.
Thank you.
Thanks for the talk.
Sure.
And looking forward to the next episode that we will also record later. Yeah,
Sure.
Yeah.
I hope I can come back.
100%. Yeah.
Okay.
Thanks.